I want to hear from Jeffrey Gundlach, DoubleLine, of course, who joins us exclusively now on Closing Bell from the ETF Exchange Conference in Miami with our very own Bob Pisani. And Bob, what a day to have Jeffrey Gundlach with us today. Take it away.
And Scotty, it is a big day, of course. Jeff joins us here speaking, of course, at the ETF Exchange Conference. Jeff, you just addressed 1,000 people in the audience. Your basic message today, interest rates have bottomed. I want to talk about CPI, but get to that message right now. Interest rates have bottomed. What's the implications for that for investors?
Well, interest rates have very long cycles historically. For whatever reason, they tend to move in a broad trend for about 40 years. And we all know that interest rates kind of rolled over at very high levels a little over 40 years ago. And now interest rates are up over the last couple of years. So it's almost exactly 40 years. And I just think that interest rates were absurdly low, particularly real interest rates. And now real interest rates are reasonable. But I think that we have a problem with the amount of money we need to borrow. And that will cause a strange movement that we're all used to thinking that the economy gets soft and interest rates are taken way down by the Fed, and long-term interest rates also go down by a couple hundred basis points at least. But I got a feeling that when the economy weakens enough so that the Fed really does cut in earnest, I think we're going to be having a real big problem with people understanding how much debt expense we have. And they might start thinking that longer-term interest rates need to be at, well, they were 10% real yields in 1984. So it's not at all implausible that interest rates could go up into the high single digits, and it's part of this long-term trend. Now, one thing, I think that the economy is more vulnerable under a rising interest rate regime than it is under a falling interest rate regime. Under a falling interest rate regime, companies that are in trouble and maybe marginal credits, even though they might have to pay more on a spread basis, they're paying lower interest rates. So they can refinance and take money out and reduce their interest expense. That prevents defaults. That supports all of the risk assets. They're reliant upon financing of marginal companies. But when interest rates are rising, maybe they'll have to default. So maybe it adds volatility to the economic cycle. And certainly that was the case when interest rates were rising in the 70s and 80s. There was tremendous economic volatility. So I think interest rate volatility and higher interest rates as a theme create more vulnerable markets.
Scott was mentioning it's a big day to have you on. January CPI was hotter than expected on almost every level. Yeah. How does this play into the expectation for interest rate cuts? The market was expecting 6. Where are you at, and how does this data today change those expectations?
I think the market has had tremendously overpriced the amount of cuts this year. It was down to almost a certainty of 6. And it seemed that the Fed, since they weren't going to move in March, per the words of the chairman, that means they're getting started in May. And then there's this thing called the election that I don't know if they probably aren't primarily focused on that, but to have 6 rate cuts between May and the end of the year always seemed like a lot to me, absent some very substantial improvement in inflationary data, which did not happen today.
Does the Fed care about elections? I mean, Jay Powell, if he was sitting here, would say, we don't make decisions based upon elections. Is that real, or is the Fed actually influenced by elections?
I think they don't want to be blamed for anything. So weirdly, it doesn't matter if they intend to be political, even if on a secondary variable, which is where I would place it. They care about the optics of things, and they would prefer, all things being equal, to be a little bit less aggressive, I think, in an economy like this. Now, the CPI today, it's funny how the inflation discussion has changed over the past year and a half or so. We went from it was going to be this super core PCE was going to be the inflation metric, and that was rolled out of Jackson Hole, I think it was, in 2022. And they don't talk about that at all anymore. But instead, back in November, when it seemed like they had a radical change in tone on November 1st, it seemed like all of a sudden we were talking about picking and choosing different inflation indicators and not focusing exclusively on year over year, but doing things like 6-month annualized, 3-month annualized. And today's report came back to bite them on this, because the 3-month annualized core CPI is going up now.
It's 4%.
It's 4%. The 12-month number is 3.9. So it's no longer, well, we can look at the 3-month annualized and take comfort, because that's what's really the trend is, and maybe it'll stick, because it's not sticking anymore. Yeah. It's going up. So what really matters, though, is not the CPI, although it's important. It's the PCE. That comes out on the 29th. And we have PPI coming out, I think on Friday, if I'm right, and that will give us a pretty good idea of what PCE is. If PCE cannot go up and have the Fed talking about cutting interest rates.
And we've all been trying to figure out what's the leading indicator to look for here. And you had a fascinating discussion here at this conference about the 2-year Treasury as the leading indicator. We tend to think the Fed leads the 2-year and moves things around. And your position was it's actually not true. It's the 2-year that leads the Fed around. So right. What is the 2-year?
The 2-year is
telling us right now.
The 2-year is sort of telling you that you're going to get about 100 basis points of cuts on average over that 2-year period.